our today's webinar presented to you by Capita. Today we'll be joined by a great panel and we'll be going through a topic of raising capital and discussing various alternatives available to founders and startups. We have a great hour ahead of us. We'll cover off on various aspects that I think will be of interest for the audience. To set the scene, what I would like to do is to give you an idea of some of the key topics we'll look to cover off today. So we're going to start off with obviously introductions of our panel and their backgrounds. And later on, we'll dive into exploring various alternatives that are available, because there's not one single pathway to accessing capital. And we all are quite familiar with the venture capital space, but what are the options available to startups and their teams beyond that? So we'll explore that. After that, we'll do a bit of more of a deep dive into actual process of raising capital. What is it involved? And what does storytelling and the role of communication affect, and how does it affect the whole process for the companies? And finally, what we're going to do is obviously quite impossible to ignore the current narrative, the current commentary around the market conditions. So what we'll try to do is have a discussion on the outlook for the markets, what the panel expects to happen in the upcoming quarters and years, and how does it going to impact startups' ability in the Australian market and beyond to raise capital. So without going too much further, I would like to introduce our panel today. So we're joined by someone who has a lot of experience across various aspects of the startup ecosystem. So I'm joined by David, Jody, and Robin. So what I'd like to do is give a brief introduction for each one of our panelists, and then I'll pass it over to them to tell us a little bit more about where they come from and what their organizations do. So David, I'll start with you first. So David here is the CEO of Fundable, which is an Australian startup. And this organization focusing on monetizing recurring subscription revenue for fast-growing SaaS businesses, and those companies that have a recurring revenue model. David's background is quite diverse, so he worked across multiple jurisdictions. And his experience is predominantly in finance, investing, lending, and particularly around structured finance, debt, and equity investing. Next, we're also joined here by Jody. And Jody is a pretty passionate leader in our ecosystem. And Jody has spent her entire career helping businesses start and grow. So Jody Moment is a co-founder and CEO of Attractive Ventures. And in her career, she helped numerous startups, the leaders, in terms of mentoring, advising, and helping accelerate those businesses. Jody's actually previously co-founded a marketplace called Occasional Butler, which was later acquired by Airtasker. So as you can tell, Jody has plenty of experience, and I look forward to hearing her insights about fundraising. And last but not least, we have Robin. And Robin is joining us from Birchal, where he is currently the Chief Campaign Officer. And he spent his entire career across the UK and Australia helping hundreds of organizations raise capital through crowdsourced funding. So Robin focuses on marketing, e-commerce, food and beverage impact at FMCG industries. And I'm kind of curious to learn about his experience working with various organizations across both markets and how he's assisted them in raising capital. So look, great panel, great topic I think we have, so I look forward to it. So at this stage, I think I want to pass to each one of you and ask you a little bit more about the organization you're currently working with. What is the problem statement you're looking to solve at the moment, and how do you go about it? So Jody, maybe I'll start with you first. Would you like to give us a bit of an introduction?
Yeah, sure. Thanks. Thanks for having me today. So yeah, Attractive Ventures was basically formed because the problem that we saw and experienced ourselves was just that challenge of getting the right fit into the VC model. So even if you really are looking for VC capital, it's sometimes very hard to get it. You know, the model lends itself to sort of 1 in 100 kind of startups actually fitting that model. So we like talking about rockets and tractors, and the rocket being that VC model. So, you know, the rockets are very exciting and some of them land on the moon, but they're also very expensive and a lot of them blow up along the way. And that's kind of the problem we're solving with the tractor, which is still very ambitious, but more sustainable and hardworking and very in tune with their customer. So, you know, if you said to a farmer, we're going to take away your tractor now, she or he's most likely going to get pretty upset about that. So they're the kind of businesses that the founders we're supporting are growing, and usually they've come from the customer problem themselves, and so have an intimate understanding of it. So yeah, we've started with revenue-based finance, and that is effectively a loan against future revenue in the business. So we are working with founders that have established that already revenue generating, from sort of $15,000 a month, ideally recurring, but also doesn't have to necessarily be. They're technology companies. It doesn't have to be unique technology. It can be technology enabled. So we've made over 30 investments since we started, really at the start of last year. And our businesses are sort of range from accounting practices through to martial arts studio software to renewable energy, sort of across lots of different industries. We also provide advice. So we've got a whole advisory team set up with entrepreneurs in residence, and a lot of our investors in Tractor, who are all exited founders or bootstrap founders, there as well to give back to our companies.
Awesome, thanks for that. Look, I think we're going to have a few questions to follow up on that and do a bit of a deep dive, but I'll let David do a quick introduction as well. So David, would you mind talking a little bit about Fundable and what are you trying to achieve?
Yeah, sure. Thanks for having me as well. So at Fundable, we're sort of trying to help founders take a bit more control of their capital journey. Obviously, when they start out, they've got an idea, they need to raise funding, and then as they go, hopefully they start to get revenue and get some traction, but of course they're still burning cash while they're getting up and running. And so traditionally there's a lot of sort of belief that you have to take on money and dilute yourself and give up some of your company to keep growing, and we believe that's not always appropriate. So we set out to provide effectively runway extension capital for founders that are growing their business and would like to be able to keep going before they take on another VC round or dilutive round. So what we're looking for is revenue. We're looking for subscriptions where people are receiving money from their clients monthly. And what we're effectively doing is upfronting that monthly revenue in an annual sort of lump sum amount so that can assist founders with working capital. So we typically find that this helps when founders are looking to do a raise and they just want to have a little bit of capital available to extend their runway, or make sure that if the VC process takes longer than they expect, that they don't have any kind of issues, or potentially they're kicking goals and they want to keep going for a little bit while longer before actually getting the metrics that they want to see before they go out to market. So we find that we sort of augment a lot of the other capital solutions out there, but really available on a more short-term basis to assist them to get from A to B according to the plan they're sort of executing against.
Awesome, nice, David. And Robin, what about you? So obviously coming from a slightly different angle with equity crowdfunding, can you please explain us how exactly that works and how Birchal assists companies with that?
Yeah, absolutely. Delighted to be here and thanks for having me. Look, equity crowdfunding is, as I think a lot of people who will come from knowing what crowdfunding is, it's an opportunity for everyday investors to get very small pieces of equity in a business which they otherwise wouldn't be able to have access to invest into. At Birchal, we really operate to simplify fundraising for forward-thinking businesses, and that really means that we want to work with businesses who are focused on building a community. They have a great story. They're thinking about the future. They're thinking about, how they can build something really, impressive that's going to attract a large audience or get a large audience really interested in investing into that business. And so while we do have eligibility criteria that we really need to satisfy as a business, we also look at whether or not that business has a very relevant story or an also relevant community that can engage with that business and actually get involved in it. At Birchal, we've basically been funded, focused on equity crowdfunding since the very beginning. So when I joined back in September 2018, coming from the UK, I really was able to see just how effective it was in building up and growing a business that was very, very focused on the marketing approach of equity crowdfunding. As businesses kind of look at this and they think, oh, it's another mechanism to raise capital, but actually you treat it much like a marketing campaign, and the capital raising element really falls into place. And so since then, we've been able to raise just over $110 million for almost 150 campaigns across the platform. And now, as we have done that, we've come across so many other products that startup founders really need as they go on and raise funds. So in this space where companies are raising funds at the capital stage between maybe $250,000 to $5 million, there's a whole host of services that they need. And there's more that investors need as well, because there's such a lack of liquidity in this space. So there's a lot that we're working on in the future, but that's where we've gotten to now as a business.
Awesome. I appreciate it, Robin. And look, before we dive into some of the detail and talk about some of the practical tips that you guys are able to share with us, I'm kind of keen for the audience to get to know you a little bit better. And if you don't mind, I'm going to use one of my favorite interview questions on you. So obviously, each one of you has plenty of experience over the years working with various startups and assisting them. So looking back on all the work you've done, what are you actually most proud of? So Robin, maybe start with you.
Dear. I was going to
you were first on my screen, so there you go.
Look, I honestly think that being able to help some of the businesses that I've helped over the years, being in the equity crowdfunding space for almost 7 years now, I've been able to work with amazing founders who truly care about what they're doing, raise funds for their business on their terms. I think that that's the one key takeaway which I've been able to help businesses with, because when it does come to raising capital, a lot of the time the power was in the hands of the investor. When you take a marketplace approach and use equity crowdfunding, the power is in the hands of the business to operate and offer investors an opportunity to invest into them. And it's simply a yes or no answer at that point in time, not this constant back and forth and then driving evaluation way down and then driving the terms that might be preferable to an investor, but not necessarily easy for a company. But I think that really just the element of being able to work with businesses, and I think a great example of this is a business called Zerali, which they had built up an amazing e-commerce platform for many years, and it was called Monster Surf, and then somebody didn't like their name, so they were told, yeah, you've got to move on, do something different. And they created a completely new brand, but they'd been operating and they didn't have the funds to basically go out and make their first big stock order. That was back in 2019. We did an equity crowdfunding raise with them, and they were able to make that purchase and then go on and grow the business. And I did a raise with them at the beginning of this year, and they've been able to generate over 3 million in revenue since that raise. And that was awesome because they were at the time speaking to angel investors who wanted to take a huge percentage of their business, because they said it's super early stage and you haven't really got anything yet. But I thought they've got fundamentally great marketing backgrounds, and they know what they're doing when it comes to building a brand and building an audience. And so I really think that they've got something special here.
Yeah, I think it always helps to know what you're doing, right? So that's a great one.
I
appreciate the example. Great story. Jody, what about you looking back? What are your highlights?
Yeah, it's a great question. I think probably the hardest thing is the thing that you end up being the most proud of. And so for me, that was Occasional Butler. So starting a marketplace technology platform from scratch back in 2011 when marketplaces weren't really a thing. My co-founder and I had no idea what we were doing, and didn't even know the term startup, the ecosystem, which was just starting, or didn't have any of that support. Just had seen TaskRabbit in the US and thought, that is awesome. Love the collaborative consumption, the whole industry, and wanted to create it. So, I guess getting through understanding, like getting through from not knowing anything to building up a marketplace and a community that was then acquired, I think it would have to be the highlight, even though it was very stressful and hard.
Well, yeah, looking back, I'm sure you have fond memories, but in a process, I'm sure it would have been stressful. No, that's a great one. And David, what are you most proud of looking back at your career?
Yeah, as Jody said, great question, because there's like so many sort of focal points that I can think of. But I think one thing that I've reflected on particularly more recently is, there's the various stakeholders in a startup or in a new business. A lot of time we focus on shareholders and the funding and the outcomes and the exits, but obviously it's a team game. And so for me, the customers and the team that you build or you're part of are really big parts of the journey, and you have to have a lot of passion for it. So for me, I'd probably say the team aspect has led to a lot of satisfaction for me. I've had the pleasure of working with a diverse array of people with really, really great skills, but it's been amazing to be able to help them develop their skills and then ultimately help the customers in the businesses they're in. But in my last job at Credible, which was a startup where we sought to sort of do something that people said couldn't be done, which was take on the major banks and provide funding for medical professionals. We were able to do that for the customers and build another option. But the team that we built ended up sort of developing to the point where one of the people that worked really closely with me on the treasury side ended up leaving Credible to start up his own startup business in a completely different area. And so for me, sort of looking at that journey and how I was able to help somebody come in, get on the journey that we were on, and then go on to his own journey and start up something new and employ people and build a team was incredibly satisfying, and sort of, I think, a big part of why we do this and sort of go through that whole journey in in the trenches of a team.
Yep. I love it. And the reason why I like this question, there's not right or wrong answer, but if there was, I think all your answers were quite right. So I appreciate you sharing those insights. So what I want to do next is to dive into the topic at hand that we have now. And I think we have a few founders joining the call, and some of them may be going through the planning stages of trying to raise capital for their organization. So I kind of want to open up to all three of you and have a bit of a discussion. For companies, you can obviously raise equity, go through the traditional venture capital pathway. You can consider venture debt, you can consider loans. There are also grants. Unfortunately, we can't cover off every single topic. But in your conversations with founders, your clients or prospects, what are the key questions you try to ask them to help them decide what would be the pros and cons of various pathways and what would be the best solution forward? So what are those key criteria that I think are quite important for founders to consider before they make a decision how to proceed?
I can jump in if you like. Sorry,
Jody.
Yep. Go ahead.
Yeah, because I'm obviously with my tractor hat on talking about revenue. And so, we talk about for revenue-based finance, for example, the best time to use that capital is to grow your revenue. So if you already, and this is the founders that we talk to a lot, they've already established that product market fit. So they know they're onto something and they want to protect their equity for as long as possible. They can also see that if they do certain things that will bring in more revenue, then that is just the perfect use case for using revenue-based finance. That way, then they can get their revenue to a higher point, which will drive a higher valuation down the track if they do want to go and sell equity. The other thing I'd just add to that, with raising capital, and particularly if you wanted to raise some equity capital, the best time for that is when you don't need it. So totally. When you're in a growth path, you're going really, really well. That's the best time. Before that, it's your valuation will suffer.
Yeah, there's so much to consider at this stage for businesses, and part of my job is to just really help educate the businesses that we speak to about equity crowdfunding, to then help them to understand where it might fit in, because there's nothing worse than having a company go through the process of pursuing a funding route that they're not potentially ready for or isn't right for their business at that point in time. It's an interesting approach that sometimes even companies come and say to me, like, why are you taking this approach? Why, you're not having a hard sales approach at all, but it's more about helping them to understand what their future looks like when it comes to fundraising. Because if they're going to go and do a fundraising round, especially at a really early stage, whereby they will have to give away a decent proportion of equity to make the offer attractive to potential investors, I want them to be thinking about the next round and the round after that. So if a business will come to me and it might be super early stage, and they might have released their product, and then they come to us and they say, we want to raise 500K for marketing. And I'll simply ask them, what have you done so far already that you can do for free without raising capital? So what do you know about who your customer is? What have you experimented with out there at the moment? Because investors are going to want to know the questions to these answers. And if you purely just worked on building your product and you haven't even tested the market, you haven't even built a potential list of people to go out to, then you're going to be backtracking and saying, oh no, we've just built the product, but we've got to experiment with all of this. And so it really helps founders to understand, okay, what position should I be in to raise funds at this stage? And, you know, Jody, to your point, if a business is generating revenue and they've got access to capital, then their need to give away equity at that point in time isn't necessary. It's really when they want to give away equity. And when it comes to equity crowdfunding, a huge part of the fundraise itself is about the marketing element and the exposure for the business as well. And so, yes, you're giving away equity, but you're getting your business out there, you're putting it on the map. And that's an opportune time in which to do so. But really, if a business comes to us and they're looking to do a fundraise at a super early stage, it's a case of what can you do that's not going to cost you money right now before you actually look to try and raise funds.
Oh, thanks, Robin. And David, I think you wanted to mention something as well on this topic.
Yeah, it's a little bit, I guess, in between Jody and Robin, I guess. Like our slogan is with a funding solution with no dilution. But, it's not that, you just need to focus on dilution on its own. So when we speak to clients, we want to understand what it is that's driving their need for capital. Are they sort of thinking they'll work with Fundable instead of doing an equity raise? Or is it that they have a plan for the capital that they want and they're going from A to B? And the reason that's important for us is our term of the funding that we give is never longer than 12 months. And so it's important that we are comfortable that the clients understand what they do and don't get when they deal with us, and to make sure that the capital that they're going to get for us is going to be used to something, value accretive for them, so that at the end of that period, they're in a better position than when they started. Because like Robin said, if it's the case that they just want to grab money and they're not 100% sure where they're going and what they're going to do, sometimes it's not so appropriate to take something that sort of has a 12-month expiry on it.
Yep, I love that point, and I want to kind of link it to a point that Robin made about educating, clients and partners and prospects. So I think all of you have either founded companies, current co-founders, or I think it's fair to say we all have like a founder's mindset. So do you have a learning from your experience of saying no or being said no whenever you try to do something for your organization or working with client that really stuck in your head as a really good lesson? So how could you use that lesson to help with education of your prospects when you have those conversations?
I've actually got a really good example in the top of my head of a time where I just said no to a founder that Bibi from Air Guides, that she wanted revenue-based finance for her company, but it was a year ago and we're in the middle of all of those lockdowns, and our credit team just couldn't get comfortable with her plan, given that we couldn't travel. So she then went to Birchal and just finished her campaign, and I'm a proud investor through Birchal into Air Guides. But just to that point too, Robin, that you just made, just that, that is also, it's a timing thing. So it was hard to say no because I really believe in those founders and that business, but just the timing of the market was bad. But then she also got the opportunity at this early stage in her business to promote the business to potential clients. Like that branding opportunity is really critical. And so that the Birchal money is better used money than the RBF anyway at this time. So that was, a no, but it ended up, I think, being the right path.
Yeah, sometimes a no is a trigger for, potentially a better option to occur. And I think, Robin, you might be able to provide a good example as well, because most recently, how all startups, you need to walk the talk and, do what, practice what you preach. And I think Birchal has done it with, going through a funding route on your own platform. Can you tell us a little bit about what you've learned through that process? Because I'm sure it's, even though you already supported hundreds of organizations, going through it on your own terms, I think might have been tricky. What have you learned from the process?
That I need to have even more empathy for the clients that I work with, because it's a huge amount of work while you're trying to also manage everything else that you're doing in the business. And I think that while we really take an approach of building Birchal as a tech business, which is as easy as possible for businesses to go on and raise funds from, and it's completely tech and focused on minimizing time that the founder needs to put into that process, there's still so much more we can do. And I think that, you know, even to that point that you mentioned about no, like saying no, we were actually internally saying that about ourselves to raise funds through the Birchal platform, because we always wanted to do it, but there was always a, you know, like another factor at play when it came to raising funds through the platform. We really couldn't ever quite settle on a time that we really wanted to do it, and we thought this isn't going to, you know, affect our clients or affect what we're doing, because we're such a small team and we're constantly just trying to keep up with the workload that's coming through. And I mean, that still was the case when we did our raise, but, you know, we got through it. We really did our very best as we possibly could. I think from a learning perspective, it really just helped me to understand much more directly the pain points that founders have when they go to raise capital, in the sense that it is time consuming. And I think, like, you know, a revenue-based finance option is probably a lot less time consuming than when you go to do an equity raise, which is part of the attraction towards it when it comes to founders through this process. I think for us, it's more about, okay, how do we fast track a lot of this other work that we've done, that we've, you know, mapped out and scheduled as a business to really scale up the operation and make it as easy as possible for founders.
Yeah, and I think we all appreciate that sometimes we assume that we know what our clients want, but, you know, going through that process, really understanding, it really helps you a lot, like helps you as a person, as a business mature, and really appreciate the other side as well. And speaking of the other side, David, I kind of want to bring you in because your background early on in your career, you obviously spent some time at a massive US bank. And since then, you've kind of transitioned more into the startup world and provided some, you know, non-traditional bank solutions at your previous organization. So what are the key takeaways from the corporate institutional side that the founders can take and consider as they transition potentially into the startup world? What from your experience would you highlight that could assist others?
Yeah, it's a really good question, because, you know, usually I'm talking about the opposite around what in the startup world is a benefit that you don't sort of get in the corporate world. But you're right, there are a lot of things that you sort of come with that background that actually can be used. So one of the things that I find very valuable is just thinking through structure where it will help you with a bit of a strategic bent. So what I mean by that is, in that startup phase, everything is reactive. You sort of have a problem and you have to solve it, and you're always putting out fires and you're always trying to do a lot with a little. But usually it's well after the fact, with hindsight, that you look back and you think to yourself, if only I had just had this perspective now, or asked a few more people that I knew, I might have tackled that in a way that would have caused a lot less pain and suffering. And I think corporates build that into their DNA. There are a lot of committees and there are a lot of meetings and there's a lot of process that you know about and you know you have to follow. But when you actually step back and you look at it, you can see that it's designed to protect the organization and protect people as they go through from going too far off track by mistake. So I think there is a big benefit to try to blend a little bit of that into your thinking and the way that you go about things in startups, because it always feels like bottom of the priority list. It's like, you know, planning is like that's a luxury that you have time for, or, you know, being strategic and having a structure to the way you do things will come. But I think if you can carve out some sort of time or some sort of way that you do your rhythm, that you can build that in, it's very beneficial. So, you know, at Fundable, we do this a lot where we sort of force ourselves to do a hindsight review, even though it's so fast moving. And we say, okay, let's look at the deals we've recently done. Where could we have done better for the client? Where could we have been faster? Where did we end up making a decision where we thought we had the facts, but it turned out after the fact that we learned more than we should have known? And I think that's really beneficial if you can force yourself to have that discipline.
Yep, I love it. So I might touch on a bit further on your point, David, that you've made around really using the hindsight and kind of the retrospect to analyze where you are. And Jody, I want to bring you in here because just looking at your resume, you've done quite a lot of work around mentoring, advising startup leaders, and especially, female leaders in the startup space across Australia. You also ran like an innovation community in Melbourne. So considering the topic of hindsight, self-reflection, and mentoring, what have you learned from that process? What do you try to implement when you work with up and coming leaders in their space?
Yeah, I mean, I guess it's a range of things. Firstly, though, I think I struggled when I started my first business, in that I didn't reach out for help for a long time, and I got to a point where I was a bit paralyzed with the stress of that until I finally did reach out to a mentor, and then I went from, that's when it started to work. But so the first thing is definitely there is such a big ecosystem of supporters and mentors and access to people who are willing to help. So just asking for help, I think, is the first thing that I would always, advise. Often it is just that, as you said, that sort of mental health. Often it's just that shoulder to cry on, or just that, that you're in a thought loop and you just don't know what to do. And so just bouncing ideas off somebody who's been there, done that, is super, super helpful. And yeah, just helps relieve stress and anxiety in the process. But then, I guess then it's all sorts of things, like whether it's pricing or whether it's, growth strategy. Yeah,
and I think I agree with you. Just getting help, reaching out for help is quite important, because I think all of us, as we kind of progress in our careers, and we kind of learn that the more we know, we actually don't know anything, right? And it's okay to ask for help and also admit that I actually have no idea about this. And that's kind of the whole point of me hosting this panel, because I don't know what I'm talking about half the time. That's why I bring you guys in to share from your experience, right? So that's kind of the benefit of utilizing the network, utilizing those around you to guide you through the challenges that we face as in the startups that we work in. Robin, next question is actually for you. And I think the fact that, we talked about the institutional side of things with David and his background, the equity crowdfunding kind of by its nature is focused on the broad community of investors, their retail investors, if you want to call them. So the nature of communicating the value, communicating the brand and the product there is quite different to when you maybe pitch your startup to a VC. So could you tell us a little bit more about the campaigns that you guys run at Birchal, and what role does storytelling play in that process?
Yeah, storytelling has a huge role to play when it comes to fundraising. I think more than ever, when I do even to cross comparisons between the two industries, I rarely think you'll find anybody who's worked in any raising environment who doesn't say how important it is to invest into people and invest in the right people. Because when it comes down to it, the kind of person who's behind that business has a fundamental impact on how successful it's likely going to be, and how they've positioned the business and how they've, come about learning, their journey to actually start up that business, where they're going, how they can help other people align with that vision as a business, because people want to invest in other people who are similar to them and have similar thought processes. When it comes to, I think, raising funds and the kind of things that we're looking for, is we really are looking for businesses who are excited by the prospect of building a strong community. In Australia, I've actually found it's probably even more important to companies to be focused on the community. I find that there are much more for-profit, for-purpose businesses down in Australia as a result of the kind of consumer behavior that we have here. So it's from a capital raising perspective, again, when you're trying to attract retail investors, you need to be thinking about that. I think when it comes to it, these investors, but not just on a retail level, because retail they've influenced wholesale investors through the platform and vice versa. But it's really been a very interesting journey, because we've seen that there is so much power in those individuals who are investing less than $10,000, and they haven't had the opportunity to invest into early stage startups before, but they don't want to invest in, traditional old industries. They want to invest in exciting startups, but their interest is actually also very driven by, okay, well, this business is, it's here, it's operating, it's doing this, but is it sustainable? For instance, like even working with an e-commerce business called Bubble Tea Club, a lot of the practices that they had to implement as a business as they grew very, very quickly were sustainable, full cycle, full loop, reuse and sustainable practices as a business. And I think when it came to fundraising, if they hadn't done that, investors would have been saying, why aren't you doing this? And so it's very much so thinking about what's in the mind of the consumer these days, and what they're after as a business. And that also transpires to what investors want to get involved in as well.
Yeah, correct. Because like you have the ability to really connect to the values of the broader community and building community, right? So you don't just buy in as an investment, you buy in because that's something you believe in, right? You want to be a part of that, right? And you really want to help drive that. And I think the reach that you have through, crowdfunding, you're able to do so because you're not going to attract just a couple of investors in your cap table, right? You're going to have potentially hundreds or even thousands, depending on the obviously size of the round.
Yeah, that's it.
Yeah. So look, you mentioned on a few things that I want to come back to in terms of the trends and Australian market versus the rest of the world, because I think we have audience actually joining from various locations. So I think it will quite be interesting to touch on that. But before I do that, David or Jody, did you want to add anything further on the role of storytelling or how that comes into play in the fundraising process?
I would say that the storytelling sort of filters both internally and externally. So, like Robin's talking about the story around the people going on the platform for the investors. But if I think about it at our business, the story is everything throughout the process. So when we meet founders, we want to get their story so that we're believers. We then have to internally convince each other that the story holds. And so, if I'm a person dealing with a client, I've got to get my colleagues across the line to believe in the story. And then that story's got to get told to others through the journey. So we're at Fundable, we're joining your journey for a period of time. And unless you sort of extend again with us, you may end up taking money from Fundable and then going on to other things. So we know there'll be other people coming in and investing in the companies we support. And they also have to believe in the story that we bet on as well. And so we see the story sort of weave its way through. It comes to us, it goes internally, goes back, and then it goes back out to the universe. And it has to continue all the way until the end for it to be successful. So we look at it at what is it now and how does the story unfold for others to then get really excited to take this business to the next sort of phase that we may or may not also go
on. Yeah, I agree with both David and Robin. I think storytelling is critical, and I'd probably add that the personal story is something I've been thinking about as well lately, because with startups, we are, even though like we're revenue-based finance and we're looking at the revenue and there is revenue and there is customers, it's established, it's still early and we are investing in the founder. So, that's across the board. And so sort of aligning that personal story as well, I think is really critical.
I appreciate your insights. So Robin, you made a good point about the trends in Australia and how does it compare to the rest of the world. So let's talk a little bit more about that. So a question to all three of you. What do you see kind of the current state of play in Australia when it comes to fundraising? Obviously, there's some things that we do a bit better in Australia, some things maybe we're a little bit behind some of the mature markets. So where do you see the Australian market at the moment? Where do you see it sort of heading towards to?
Who do you want to start?
Oh, why not start with you?
Yeah, look, it's interesting. I think I'll answer where we're at the moment at the end of this, but really, my comparisons to the UK. Look, I've spent some time in the US, not in a startup capital raising environment, but definitely spent some time out there and can see and have met a lot of really interesting founders. In the UK, really interesting founders and interesting approach. In Australia, definitely different approach, but one that I've come to really love, and I love the transition of coming down here. And I think that really what I've found in Australia, like I mentioned around the aspect of the for-profit, for-purpose difference that people do have a lot more of a focus on in Australia in comparison to businesses in the UK. I would say that over here, there isn't necessarily, it's not necessarily a bad idea to be thinking about how you can sustainably grow a business to profitability and then run with it and make it work for yourself. I think overseas, there's such an obvious route to gain, early stage investment that people initially build up a business, they build up their first users, and they go straight to raising capital because they can, and they figure out all these problems along the way. But while they're doing it, they're very focused on growth and they never think about profitability. In Australia, businesses typically start to think about profitability earlier on. I think for the majority of the businesses that I've come across, and I think it's a great thing to be thinking about that, because as a business, like really, of course, you can continue to think about growth, but when you continue to think about growth and then profitability becomes much more of an afterthought, it can become a huge issue for the business, especially if it's unable to raise capital. So I think it's a really smart way of thinking about a business and thinking about making it sustainable and thinking about making it work long term, because sometimes if businesses grow too fast, problems arise much quicker, and you've just got to constantly be putting out fires. And so I think that approach has been really strong. In the UK, for instance, raising capital has definitely, the rise of equity crowdfunding has been huge for businesses to be able to raise capital, and it's been a fantastic addition to that aspect of raising capital. The VC market, though, has expanded significantly in the UK, and access to capital has been very well, not easy, I wouldn't say completely, but much more accessible for a lot of businesses overseas. And so we've seen that a little bit in Australia, but again, I do think that the approach of raising what you need to, not going completely overboard in terms of capital raising as a business, it absolutely has its benefits long term, I think. And then we don't get these cycles of huge growth and then a massive slowdown. So yeah, that's my main comparison.
Yeah, no, that sounds like a pretty reasonable approach, and I think quite a lot of good takeaways from there. Jody, what are your thoughts?
Sorry. Yeah, I pretty much echo what Robin said. I don't really have anything else to add to that.
Awesome. Keep it short. And David, anything from your perspective?
I sort of have noticed a couple of things. I lived in the States for 6 years before I came here, and I have a lot of sort of friends from college who've gone to Silicon Valley, and there's sort of two things that strike me that are a little bit different in Australia from those bigger markets. The first is the market. So what we find a lot of the time when we speak to founders is they're already thinking about going offshore by the time we're sort of having a conversation with them, which is a natural thing in Australia. Everybody knows Australia's market is smaller relative to some of the other developed countries. So they're getting sort of their ducks in a row in Australia, and they're already thinking about, am I going to Europe? Am I going to Asia? Am I going to America? Whereas if you're in America or in the UK or in Europe, you're already in a big market. And so for you, it's just about growing where you are. So there's a slightly different dynamic to that, because, if you know everything about your space in America, you're just sort of capturing there. Whereas, the Aussie guys have to understand how they're going to go overseas. Do they travel there directly? Do they build a team remotely? And all of those challenges are a little bit different, much earlier than I would say they are overseas. And then the other thing is, again, back to that market, because it's smaller here, there's certain, my observation is there's certain pockets that are developing really rapidly and becoming world-class. So I remember when I came to Australia in 2012, that was like right at the beginning of some of the really big and successful funds that we all know today. But at that time, it was very nascent. There weren't, these big VC funds that people understood. And so now that that's sort of much more developed, as we look around things like revenue-based financing and venture debt, it's still very nascent relative to the explosion we're seeing in the founder and startup ecosystem. And so again, the optionality that people have once they're going, like Robin said, overseas, there's just a lot more ways you can get capital, and it's a lot less frictionful. Whereas over here, there's certain sort of molds, and if you fit that, there is now capital. But if you don't, it's just a lot harder. And so probably that's why they also start thinking a bit more about profitability. It's just about being more sustainable, just because of that market situation.
And next, I would love to get your thoughts, and it's really hard to ignore the current commentary around, the market conditions and the outlook for the future. So obviously, what's happened in public markets has trickled down to the private markets as well, and the current sentiment is quite bearish. Whether that's the narrative, maybe that's going to stick around for the long term. When you think about investors, I think the markets that have experienced quite a lot of influx of venture capital over the last couple of years can probably expect the next maybe 4 to 6 quarters to be more bearish, and quite a lot of pressure on startups to perform and survive. So Robin made a good point about it's not just always about growth, it's about being able to sustain that when you're not able to access capital easily. So my question, and Robin, let's maybe start with you. What's your view on the current market conditions and the outlook for maybe the next 12 months? How do you think that will impact your business?
I kind of get this question almost every day, sometimes multiple times a day, from founders who are looking to raise funds. What they're looking for from our side is more, are our businesses still able to raise capital? Are they being affected right now? From our data-led approach, we're seeing that businesses are still able to raise funds from, through the Birchal platform, through their own communities. We've got really good conversion data from an expression of interest campaign to an investment offer, and we're still seeing that it's being effective. And so it's really promising to see that even when public markets are very bearish, that people are still willing to commit to investing into businesses long term. And I think for founders, they're really weighing in on that factor that, look, we're here to build this business. We're not focused on what's going on currently. We're going to be around for many, we're focused on being around for many years to come, and we're focused on this growth. And I think that really it's about reassuring investors that they have put provisions in place to the business to make sure that they can ride this wave, whatever it looks like over the next 12 to 18 months or even longer. I'm saying to businesses right now who are looking to raise funds, no matter what path they're going down and no matter which mechanism they choose, to at least give themselves enough of a window to ride it out. Because I think over the next 12 months, it will certainly become more difficult to raise capital for early stage businesses. I think it's just the reality of what we're heading into. Nobody fully knows what's really going to happen over the next 12 to 18 months. There's a lot of confidence has been stripped from the market, but there's all kinds of conversations which people come on the phone to me and start saying to me about, and I think, I wonder what you've been listening to, but I'm really, just want to serve you and help you and make sure that if you are looking to raise funds in your business, do you need to raise funds right now, or are you just simply trying to raise funds and continue on a growth curve that maybe isn't likely to happen in the next 12 to 18 months? So it's really about just understanding the position of the business and understanding the market that we're in right now.
Yeah, great points. And Jody, are conversations with your portfolio companies and prospects quite similar?
Yeah, we're having an absolute surge at the moment. Everyone's very nervous about their valuations, and we're seeing valuations, reduce even more. And so, I still think, and further to what Robin was just saying, still the best capital for your business is customer revenue, any time in any cycle. But I think, the more that you can obviously get your revenue up to counter that slide in valuation without having to sell shares, the better. So it's actually a really good time for looking at alternatives.
Yep. And David, what are your thoughts on the potential impact and challenges around recurring revenue in the current climate?
Yeah, just like Jody said, that I think everybody's feeling it. The way we're feeling it or experiencing it is clients are coming to us saying, we want to sort of get some revenue-based financing from you because we're not sure how long the process is going to take for raising. A lot of them have started a process and they had an expectation that it would take a certain period of time. And as they've now got into it, they've realized things are just not happening as fast as they used to. So that probably speaks to various investors just doing more thorough due diligence, maybe sort of taking things slower and being, much more conservative in the way that they're underwriting. So we're seeing people sort of saying, okay, we need to have maybe some other options up our sleeve, so that if we do need to sort of rely on ourselves for a bit longer, that will be necessary. And like Jody said, that's revenue based. I mean, we want to see people who can put more revenue on, and obviously we love to fund people who can use our funds to accelerate that. And so I think the other interesting thing about revenue-based financing opportunities is this is actually a big tailwind for us, because there are lots of companies that have raised a lot of money and are doing really, really well, and may have thought, you know, we've got a lot of runway, we don't really need to be concerned about raising capital at the moment. And now all of a sudden we're seeing their CFOs or their finance heads saying, actually, it might not be a bad idea to just explore all options. So that obviously for us then brings a whole clientele that we'd love to serve into the frame.
Awesome.
Can I just add there,
yes,
just on the timing, it's come up a few times. I think that timing, the time it takes to sell shares versus the options like revenue-based finance is, you know, very, very different. And so for us, for example, it takes 2 weeks from us meeting you to us having money in your bank, if we proceed. So I'm not sure what it is for you, David, but it's, you know, it's significantly less time than selling shares.
Absolutely, it's much less time, and it's also a lot more certainty, because you know, if you guys are doing it in 2 weeks, we typically do it a little bit less, but oftentimes it just really depends on the situation that the founder's business is in. What we find that people really value about that as well is they know very quickly if they're heading to a good outcome or if it's not going to work, and that obviously gives them that certainty to know what's next. Whereas some of the other processes can take quite a long time, and it takes quite a long time before you know it's actually going to get there, which is obviously very stressful.
Yeah. So both of you made a really good point, and I actually want to quickly touch on that. I'm being mindful we're coming up to the hour mark, but I have 3 questions left for you, very quick ones. So you mentioned the turnaround time. So the question I actually had in mind is that what can founders do to be sort of investment ready? What they can do, what should they prepare to ensure that they're in the best position when they have those conversations with your organizations about having access to capital? What's your advice?
Me first?
I think
David, sorry, David, you go, please go. Yeah.
We definitely encourage founders to be investment ready at all times. There's some really nice tools. We use them ourselves, like Robin said, you know, just went through a capital raise ourselves. There's some really nice tools you can get to effectively have a sort of a data room ready at all times. And so we encourage people to have your house in order and then just incrementally fill that room up, rather than get to the point saying, oh, we need capital. What's that process look like? Educate yourself and then have to get all the material. It's really easy to sort of have your accounts in good order, save them in a data room, you know, have whatever other pitch decks and other materials that you have to accompany that. And just basically, as you know, as business travels through time, just update it rather than have to sort of collate it from scratch when you're in a bind. And so I'd highly encourage people to sort of get that data room up and running, and then it's just an easy process as you go.
Awesome, appreciate it. Robin, you had a thought as well?
Yeah, look, I mean, it's super challenging, but I try and ensure that founders aren't just working on one thing at any one point in time, because then if you're working on one thing, you haven't paid attention to something else, which investors are going to want to focus on in the business. So that's, you know, whether or not you've gone out there and you've understood who is in your market, who's likely to, you know, want your product or service out there. Again, the same on the product. If you've built a list and you've built a community, but then you haven't even started the build, like, it's a case of like, how are you going to actually, how far away is this from being investment ready? I think that when it comes to businesses and their communication, openly transparent communication about how you've built this business is so effective these days. You've seen some businesses which have basically started and they've just documented everything on LinkedIn. That is a very incredible way for a founder to just say to someone, like, this is what I've been documenting from the get-go, from a capital raising perspective, and this is how you can kind of get engaged in my story. You know, David, even to your point, really around getting your accounts in order, keeping everything, you know, operationally up to date. That is just, it's one of those things that people just have to then end up doing if they go and raise capital. So they're just creating work for themselves if they kick that down the road. So yeah, it's keeping everything well balanced, I think.
But you can't avoid it, so you might as well do it in little bits rather than do a chunk. I guess it's like that in all things, really.
Yep.
100%.
Yeah, no, that's right. We had a quick question come from one of our audience members, and Jody, David, that's more directed at you. So I think both organizations are looking at revenue, but I think it will be good to understand what kind of businesses do you normally work with. So David, for you, are you focusing only on SaaS companies? And this is more just a solution for subscription-based businesses, or do you work with other organizations too?
Yeah, so it's not just SaaS companies. I think the key ingredient for us is a monthly payment or a regular payment that's the same every time. So obviously the way our product works is we see a regular payment that comes with a frequency we can understand, and then we upfront that money for you today against a 6, 12 or 9-month period. So as long as we can see something that's regular and continuous, then we can fund. So where that gets tricky is if companies have project-based work or lumpy work, where their revenue might be 100 or 5 or 30, it's very difficult for us then to have a profile and fund against it. So as long as that's the attribute, we can do it. And so we've done a lot of SaaS businesses. Obviously, that lends itself really well. It's super easy. You can see the product, you can see the monthly amount, and you see the customers. But we've done education businesses that have courses where people pay for the courses on a monthly payment in order to receive the tuition. We've worked with some recruit tech firms where there's placements that have a sort of a profile like that. So as long as there's something regular and monthly, then we'll fund against it.
Awesome. And Jody, from your perspective, like what organizations do you normally work with?
Yeah, well, as I said at the start, like it's very, very broad ranging. I think sounds to me like the key difference between Fundable and Tractor, well, there seems to be a couple. So I think you might be working with shorter terms, David. So where our loans go for 2 or 3 years typically. We see our first finance opportunity with a founder to be the first of many. We've got, we can help with capital raises down the track. That advisory part of what we do is like very active. So that's something different. And we have new products that we're developing in the background as well. So we sort of see our relationship with the founder to be long-term. We want to grow with the company over the duration.
Yeah, I think that's definitely, if you guys are looking sort of longer than a year, I would add that we do a year at a time. So, it does happen where founders take money from us and then they come back and say, can we top up or can we extend? But each time we draw down more money for the founder, it's for a 12-month period. So that can roll, and we do want to grow with them. But yeah, I guess it's finite in that respect.
Cool. Thank you both for clarifying. 2 last very quick questions from me. So this one I quite like asking, and it's pretty hard sometimes to answer. Robin, what's the best advice you have received or have given, or you're willing to share at the moment with founders in our audience?
Oh, I don't know if this is the best advice I've received, but I think that when it comes to fundraising, you really do have to listen twice as much as you have to speak, really in understanding a business. I think that from a perspective of just understanding their needs as a business, that can really help save you time. It can really help you to just build much better relationships with people, because in Australia, and what I really do love about this market is that it is very relationship based, and everybody has a touch point with someone. It helps everybody to keep much more connected and honest and authentic. And so I really love the industry as a result. I don't think it's the best advice I've received, but it's
but that's definitely a good one. Yeah. Jody, any words of wisdom you would like to share?
Yeah, definitely get advice.
Yeah.
Seek advice for sure. Another tip that I've given regularly is like really, I think founders get a bit nervous about their numbers sometimes, and so getting to really know and understand your numbers and not be afraid to sort of dig in and understand the key metrics and that sort of stuff. I think that's critical, and then I think also looking after yourself. So it's not a race; it's a marathon, and you need to take care of yourself.
Yeah, very important. David?
Yeah, Jody's last point would definitely be mine. It's a marathon, not a sprint. There's very high highs and very low lows. And I think trying to find the balance in your work and out your work to be able to sustain yourself through that is super critical, because otherwise it's really easy to burn out and things take time. So as long as you can sort of work on strategies that allow you to sort of sustain those down periods, then you'll be fine.
Awesome. I appreciate it all. Look, thank you all for your time. Before I let you go, if the audience wants to kind of reach out to you and ask follow-up questions or learn more about your organization, what will be the best way for them to contact you? So Robin, LinkedIn, email? What do you prefer?
LinkedIn, email address. Yeah, my email is robin@birchal.com. So super easy, but if anybody connects with me on LinkedIn and asks me a question, that's also very, very easy for me.
Nice one. And Jody, what about you?
Yeah, probably email's the best, jody@tractorventures.com, but I'm also on LinkedIn.
Nice one. And David, I know you've come very well prepared, which was, like one of the advice given as part of this discussion that we had today. So just sharing some of the David's contact details and the QR code everyone can scan to learn a little bit more about Fundable. Anything else you wanted to add, David, while the slide is up on the screen?
No, thanks very much for having me. And yeah, I guess also LinkedIn, I'm very active there. So if anyone wants to hit us up, we'd love to have a chat.
No worries, I appreciate it all. And look, this is the first in a series of events. So look, my name is Amit and I work with a lot of organizations across the Southeast Asia and that region. We help companies on the journey. So I really enjoyed the conversation with our panelists today, discussing various options available to the companies. If you're keen to sort of stay in touch, learn more about what we do in the future events we'll look to organize to really help share the knowledge within the ecosystem, feel free to reach out to myself as well on LinkedIn, and then we can go from there. So thank you all for your time, and hope to see you in future events. And the industry is small, so this is not the last time we see each other. So thanks all. Cheers.
Thanks very much.
Thanks, everyone.
Great
Thank
session.
you.
Cheers, guys.
Awesome. See ya.
Bye.